Aslında bu organizasyonun partneri bir anlamda böyle de nitelendirebiliriz partneri olarak. Asia Insurance Review the Middle East Insurance Review'un CEO'su Şahla Suppaya. Sahneye davet ediyorum. Please. Thank you.
Thank you very much. Good morning to our opening speakers, VIPs, delegates, Ms. Ozgu Bey, Menekşe, ladies and gentlemen. And welcome to the conference on behalf of Middle East Insurance Review. It is our extreme pleasure to be here for the third year running to host the third Turkey rendezvous in conjunction with the 3rd International Insurance Summit and the 16th International Istanbul Insurance Conference. We are very pleased indeed to have 545 delegates from 22 countries here, of which 256 represent insurers. Thank you everybody and welcome to the conference. When we first launched the Turkey rendezvous, it was with the intention to raise the profile of the Turkey market internationally as a major industry hub, especially after the challenges of the Turkish market has faced. Turkey stands at the crossroads of East and West, Asia, Europe, and in some ways the Middle East. And we at Asia Insurance Review and Middle East Insurance Review, who represent being on the cusp of both Asia and the Middle East, felt we were in a very perfect position to help do this. And with this in mind, we are very honored to be here together with the Insurance Association of Turkey, IUC, and STD to follow through on this commitment. The theme, Narrowing the Protection Gap, Turkey's Journey to Resilience and Sustainability, really fits in well with this agenda. We are now facing so much uncertainty and instability throughout the world, and I need not remind you that, of all that is happening on the world stage as we speak. There is therefore a critical call for insurance markets to unite to promote resilience and sustainability and to promote trust in an ever-changing world. In Turkey, as we see elsewhere, the protection gap remains a significant barrier to economic stability as well as the individual security of its people. Sustainability and environmental consciousness must influence insurance practices, and insurers must stay ahead of the game by developing products and services in order to demonstrate a concerted effort to narrow this protection gap. And so here we are. Over the next 2 days, the program has been carefully designed to address this in key areas, including the future of life insurance and bridging the retirement protection gap in a rapidly aging society. We will also look at assessing earthquake risk solutions in order to enhance the resilience of Turkey moving forward. We look to AI and technology advancements for solutions for the future needs of Turkey as well. Our intention, ladies and gentlemen, is to come up with real solutions for Turkey and the surrounding region. We are very grateful to all our sponsors, speakers, and supporting organizations for the dedication to this cause and support. And it is with this, I would also like to personally thank the Insurance Association, IUC, and STD for their partnership with us in bringing this event to you. We wish you all a very fruitful conference and hope you meet new friends and go home with fond memories of Turkey and our gracious Turkish hosts. Thank you very much.
Sesi açabilir miyiz arkadaşlar? Ses. Evet. Efendim çok teşekkür ediyoruz. Thank you very much. Çok mersi. Evet. Sayın Suppa'ya çok teşekkür ediyoruz. Şimdi Guy Carpenter, Global İlişkiler Başkanı Sayın Charles Whitmore sahneye davet ediyoruz. Please. Bir alkış alalım lütfen Sayın Whitmore.
Good morning. I managed to achieve my primary objective, which is not tripping up the steps as I walked here, so everything else will be easy. Thank you very much for the introduction. Let me start by saying thank you also to the conference organizers and the hosts for putting together such a spectacular event in such a special location. And thank you for inviting me to be here with you today. It's a great honor and a great privilege. I work for Guy Carpenter in London. Guy Carpenter are a firm of specialist reinsurance brokers. We are part of the Marsh McLellan Group, extremely committed to the Turkish market. We're delighted to be the lead sponsor of the conference this week, and we look forward to servicing our clients for many years to come. I'm also going to start with an apology, which is, I'm sorry that I have no Turkish, and that I will be speaking in English, but I'm sure that our excellent translator will be able to keep up with me, and I will speak slowly so she can understand. Okay. The conference theme of narrowing the protection gap and promoting resilience and sustainability has never been as relevant as it is today. And my presentation will address these topics in some detail. I'll start with an overview of the current reinsurance market, talk about the current protection gap status across the globe and in Turkey, and then consider ways in which we, as the combined insurance and reinsurance market, can come together to narrow the protection gap here in Turkey in practical and achievable ways. So let's start by looking at the recent loss activity to have impacted the reinsurance market. Large losses have continued to increase over the past several years, with the losses from the first half of 2024 already higher than that of 23. And one of the areas of note and particular concern in the market is that much of this recent loss activity has been caused by what we call secondary perils. So what is a secondary peril? Well, it's everything that's not a primary peril. And the primary perils are hurricane and earthquake. So these secondary perils have become the main driver of loss in recent years. Flood, wildfire, severe convective storm, particularly in the US, and recently here in Europe, hail, and we're just experiencing drought. And the problem with the secondary perils is that the models are still very underdeveloped for these perils. And as a result, the insurance industry finds them hard to price and hard to underwrite. But the good news is that reinsurer risk capital is at record levels. And this level of capital can be used as a barometer for the health of the of the reinsurance market in general. The dip you can see in 2022 followed a poor loss year and turbulent financial markets, and it was repaired already in 2023. And in 2024, we saw a significant increase in capital levels via retained earnings after a very profitable 2023 year. The light blue bars denote non-traditional capital or alternative capital, such as parametrics and cat bonds, increasingly used by cedents to complement their traditional reinsurance program. And I'll return to this subject later in my talk. So although reinsurer capital has firm expectations on the levels of return that is required for 2025, and while there is little fresh capital being raised, we anticipate that there will be a sufficient supply of capacity to cope with the increased levels of demand as we look forward to 2025 and beyond. When considering the health of the reinsurance market, it's obviously important for us to think about profitability levels. Are the reinsurers making any money? This chart highlights reinsurer cost of equity in light blue against reinsurer return on equity in dark blue since 2005. And it's clear to see that during the period 2017 to 2022, coinciding with those bad loss years we saw earlier, reinsurers only exceeded their cost of equity twice, which for an investor is clearly not a healthy return. In contrast, 2023 returned a very significant return of nearly 22%, and this is estimated to be nearly 18% in 24, and then well in excess of their cost of equity in 25 and 26. And these very positive levels of return by reinsurers have helped to restore investor confidence and generate a strong desire for them to write more business in what continues to be a very healthy trading environment. Okay, so coming now to the central theme of my talk today, and of the conference in general, narrowing the protection gap. The protection gap is defined, as was mentioned earlier, as the gap between economic and insured loss. And globally, in 2023, there was economic loss of $291 billion, of which $280 billion was caused by natural perils. And it's because of this contribution that I'm going to focus on natural perils in my talk today. Of this $291 billion, only $117 billion was insured, which represents a gap of around 60% globally for 2023. And as you can see, the numbers vary by region, with North America, Latin America, Europe, and Australia, New Zealand all having a similar level of insured loss of between 40 and 45%. This drops when considering Asian territories. And when you look at the Turkish earthquake loss of Kahramanmaraş last year, the number drops to a pretty low 6.3%. And it's important to note that these figures are using the rates of exchange in force at the time of the loss. But I think this represents a stark and urgent reminder that while great progress has been made via the establishment and development of the TCIP earthquake pool, much work remains to be done to increase the resilience of the Turkish economy and building stock against large loss events. So how is this best achieved? I mentioned that the TCIP has been very successful since its establishment in the year 2000, increasing penetration to 56% nationally in 2024. Its true real value was witnessed in the aftermath of last year's earthquake, when it succeeded in paying out 95% of damages within 2 months of the loss occurring, and in doing so, delivered vital financial help to those in maximum need. And this type of public-private partnership is growing in popularity across the world, primarily because of their unique ability to generate higher levels of insurance penetration amongst the general population than private markets alone. Designed well, these partnerships can help return risk to the private reinsurance and insurance markets, and therefore de-risk the government balance sheet, and at the same time become a national center of excellence for data and for expertise on climate risk. Increasingly, these public-private partnerships have a core purpose of promoting resilience, often through incentivizing policyholders to build back better following a loss. Several employ incentivization techniques such as lower premiums for improved risk mitigation and for superior construction. The Taiwanese PPP, TRIF, offers a really interesting parallel to yours. It was formed not long after their own devastating earthquake in 1999, and since then, it has overseen a comprehensive retrofitting process of all buildings, graded according to national importance. And as a result, the impact of recent earthquakes on building stock and economic disruption was significantly lower than seen in 1999. I think this represents a good example of how to embed resilience into the national economy to withstand the most destructive impacts of disaster risk. A key feature in encouraging new investment in climate risk is the development of sophisticated and accurate catastrophe models. Let's now take a look at the experience of the recent Kahramanmaraş earthquake last year, because in many cases, the losses generated did not align with what the models predicted. And much of this, I think, can be explained by the very unique characteristics of the earthquake. So the losses happened close to the Antakya Basin, and the soil characteristics present in that region amplified the ground shaking effects. Damage ratios were also aggravated by the fault directivity effects, which meant that the ground rupture speed was close to the seismic wave speed, serving to increase the intensity of ground shaking. And of course, the very significant impact of two large earthquakes, or an earthquake doublet, in a short period of time meant that buildings initially weakened by the first impacts were then much more severely damaged by the next set of shakes. However, we are aligned with many other modeling firms in the belief that the unique conditions that contributed to this earthquake are not present in the key area here in Istanbul. The geology is entirely different. There's no basin here, for example. It's incredibly unlikely to again have this earthquake doublet happen. And the building codes are very rigorously applied. Nonetheless, the damage curves have been adjusted to reflect the lessons learned in the quake last year. It's very important that industry uses the most recent data available to update the CAT models to most accurately reflect natural peril risk. Because in this way, insurers and reinsurers can more efficiently forward price climate risk and be more confident with their risk selection and their provision of capacity. And this is even more essential when considering perils which are influenced by climate change, such as flood and wildfire. The insurance industry is engaged in something of an arms race to better quantify, assess, and price climate change when viewed through the prism of climate change. And so accurate data is a key component to make real progress in this initiative. So having looked at PPPs and the development of next generation of CAT models to best reflect the nature of risk in Turkey, let's now look at different forms of capacity which are available to help narrow the protection gap. As we saw earlier when looking at reinsurer risk capital levels, nearly 20% of current global reinsurer capital is made up of alternative capacity. But here in Turkey, the use of alternative capacity is much lower. There is a growing trend in other major markets for purchasers of large catastrophe programs to make use of alternative capital. And one of the main reasons for that is that it allows the buyers of reinsurance and insurance to diversify their capital sources. And they do that to reduce their reliance on what can be a very volatile and unpredictable annual reinsurance marketplace. Most buyers use alternative capital to augment their traditional program and have started to think about matching different types of capital to different types of risk in their portfolio. So their reinsurance programs have become more diversified according to the different types of capital employed. A common type of alternative capacity is parametric insurance and reinsurance. So this works, instead of reimbursing exact liabilities on an indemnity basis, the parametric product pays out a pre-agreed amount once a loss of a certain size has happened. Because there is no need for the old process of assessing the level of damage at each location, sending in the loss adjusters, and then considering whether each claim is valid or not, the payment to the policyholders is extremely rapid, often taking no more than a few days, because it's based solely on whether a loss of a certain size has happened. It's quick, it's transparent, it's versatile, it's usually very competitively priced, and it can be customized to fit unique circumstances, both as insurance for policyholders and reinsurance for insurance company cedents. Here in Turkey, the parametric products are available for the main perils of flood and earthquake, and indeed, following the recent loss, several parametric deals were structured to augment insurers' traditional reinsurance programs. Parametric products have grown in popularity in recent years and are a very useful way of purchasing catastrophe reinsurance, particularly in emerging economies where exposure data can be hard to pull together. But the one downside of parametric insurance and reinsurance is that the possibility exists that your own loss may not align to the loss upon which the policy pays out. In other words, you could have a loss that isn't covered by the parametric policy. And we call this basis risk. And in recent years, much time and resource has been spent on developing more innovative and sophisticated ways of reducing basis risk. And in this instance, we see here an optimum payout has been assigned for each magnitude level by cell. The chart on the screen shows how cells can be constructed for the Marmara region, where the lowest thresholds are in the proximity of the Istanbul metro area in order to maximize the payout available should a loss occur. Another common form of non-traditional capacity is cat bonds, or insurance-linked securities, or ILS for short. The cat bond market has grown significantly in recent years, not only because buyers of large catastrophe programs want to diversify their capital sources, but also because the historic pricing gap between cat bonds and traditional reinsurance has closed significantly. The other reason for this growing popularity is that this product usually has a 3-year duration, and so it therefore acts as a very efficient hedge against the annual traditional reinsurance product. The cat bond market has grown 50% since 2015, a testament to the popularity of the product and also to ILS investor interest. And just in the same way as insurers and reinsurers rely on a diversified portfolio to be able to leverage their capital efficiently, ILS investors also need diversification, and in their case, away from their most popular perils of US hurricane and US earthquake. And as a result, in recent years, there has been considerable growth in cat bond issuances for European wind, for Japanese perils, Latin American quake. And so the timing is very beneficial for the Turkish insurance and reinsurance market to now consider cat bonds as part of its overall cat purchase. So, in summary, insurance can play a significant role in society's ability to recover from disasters by providing critical financial support post-loss through its risk transfer process. To make the insurance product as effective and as widespread as possible, it's important to promote risk awareness amongst the wider population. Improve the general risk culture where accurate and transparent data is available, and also where the incentives for risk mitigation by the risk owners themselves are widely available and broadly communicated. Data has shown that stronger buildings and infrastructure significantly reduce financial losses and costs from natural disasters. Insurers have the opportunity to play a larger role in Build Back Better initiatives by facilitating and incentivizing both post-disaster as well as pre-disaster structural improvements. Ultimately, though, enabling appropriate impact on resilience will require a greater effort than that of individual firms or organizations. So it's therefore essential that the industry and its stakeholders engage in widespread collaboration and take collective action to increase resilience globally. And lastly, the government cannot be expected to act as the insurer of last resort forever. It's essential to de-risk the government balance sheet via the effective transfer of risk into the private insurance and reinsurance markets, not only through the use of non-traditional insurance and reinsurance capacity, but also via attracting new investors through the use of the latest cat risk modeling techniques. I hope you enjoyed the rest of the conference. Thank you for having me, and thank you for your attention.